This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So where are we up to in this big consolidated statement of financial position chapter? Well, we're actually in quite a good place because we've recapped the bits that you've seen from financial accounting. So we've covered the basics of consolidation. We've brought in this non-controlling interest. We've looked at the calculation of goodwill. And we've looked at the workings and how those workings can help you immeasurably in answering a full group statement of financial position question. What we need to go through and do now is just bring in some adjustments that we need to make. Because remember, when we initially introduced the concept of group accounts, there were some important principles that we needed to apply. We've applied the control and ownership aspect. With regards to we control all the assets and all the liabilities. We've looked at the ownership with regards to the equity. So share capital, share premium, group retained earnings and non-controlling interest, showing effectively what we have with regards to what the parent shareholders own, and what the non-controlling interest own, and then totaling that up to get the total equity, the total ownership, within the subsidiary. However, the other concept that was within there was looking at the concept of substance over legal form and the fact that separately P&S are two separately legal entities. So they will be recording transactions in their books as they happen. But when we bring them in together as a group, we treat them as a single entity. So here, we need to start looking at adjustments that we make based upon the single entity concept. The fact that yes, P&S separately are two legal entities and will prepare financial statements and submit them to Companies House. But for the group financial statements, it's based upon one single economic entity, isn't it? So going back there to the framework. So what we've got there, the first one that we look at is your intra-company balances. So it could be that P&S trade with each other, and when they trade with each other, they buy and sell goods on credit. So there could be a receivable in one set of books and a payable in the other set of books. Now legally, P&S have a receivable and a payable. So they exist legally within P's books and within S's books. But in the group accounts, when we bring it in as one entity, the shareholders within the group are only really interested in what happens from the group and the outside world. But they're not worried about what happens between the group members, are we? So because it's a single entity, we're going to remove the balances that are due between the group members. So if there's a receivable in P's books and a payable in S's books, we're going to remove the receivable and remove the payable. So here what we have is that your removal of the receivable is effectively whereby we will credit your receivable and you debit your payable. Okay. So you reduce the payable and you reduce the receivable. Okay, because we can't owe money to ourselves, can we? Okay. The group can only owe money to the outside world. We can't have money owing between P and S. Okay. Based upon the single entity concept. Okay. The other scenario that you've got there is your cash in transit. So what could happen there is that just prior to the year end, the company that has the liability makes the payment. So they will have credited bank and debited the payable. But the key bit there is that the selling company will not have received the cash. So they haven't yet recorded the cash receipt. Okay. And the issue that you've got is that this cash payment that's been made is just sort of floating around within the ether in cyberspace, isn't it? Now, the online payment has been made. The receiving company has yet to receive that cash, but it belongs to them. So it's not actually being recorded yet. But if it's theirs, we need to record it, don't we? So what we have to go through and do there is, first of all, we will record the cash in transit. And that just sounds fancy, doesn't it? Cash in transit. It's just a normal cash receipt from a credit sale. So what I would do there is that I would debit the bank and credit the receivable. Okay, so effectively increasing the bank balance within your group SFP and crediting the receivable, or reducing the receivable balance because that balance is no longer outstanding. You have received the cash, or at least you will do. Okay, and then what you need to go through and do there is remove the intra-company receivable and payable. So whatever else is left, there'll be other outstanding balances. So you will need to go through that and debit the payable and credit the receivable. So effectively doing what we did in terms of the removal of the intra-company balances. How do you know what the balances are? How do you know what the cash in transit is? You are told it within the question. Okay, you'll be told the value of the cash in transit. You will then be told the intra-company balances, and you can eliminate them one by one. Okay, there we go. So they're the first of the balances that we need to adjust for. Of those, the most commonly examined would be the intra-company balances. Cash in transit is a bit of a challenge. So if you see it, move on and do something else first. It will be much easier and make your life that bit easier. So here you've got the illustration to show your cash in transit. So it says here, P has an intra-company receivable of $1,500 at the year end due from S. Okay, so you've got a receivable of $1,500 and that's in P's books. It does not agree with the corresponding $1,000 payable in S due to a check of $500 sent by S immediately prior to the year end, which P did not receive. Okay, so that 500 is the cash that's in transit. That's what S has paid. S will have credited its bank account and debited its payable. So reducing it from probably what was 1,500 down to the 1,000. However, what we need to be able to do is we need to record that cash in transit first, because it still belongs to the group. It's just in between the two groups, isn't it? Or the two companies within the group. S has sent it, P's not received it. It's floating around in cyberspace. So let's record the cash in transit. So we debit the bank and credit receivables with the $500 cash in transit. Because what then happens is that this receivable will now go through there and reduce by $500. So will now be $1,000. Okay. So now we have equal intra-company balances. Those equal intra-company balances are there at $1,000. So I debit the payables. So reduce the payables and credit the receivables. So reducing the receivables. Where do we make these adjustments? You don't need to do them in any workings. You don't even need to write out the debits and credits. I'm just demonstrating them to you to help you fundamentally understand the accounting. You are going to be accountants, so it's important that we understand the fundamentals. All you go through and do there is you will just adjust the bracketed working. So whereby we've got, let's just say that, is it the payables? You would consolidate 100% of P. You would add in 100% of S. And then let's be specific here. you would deduct the 1,000. That 1,000 being the 1,000 there. Okay, the debit to the payables, the reduction in payables, hence why we are deducting it. Okay. Likewise with the receivables, you've got to be a little bit more careful there, haven't we? You've still got 100% of P, 100% of S. Here, for the cash in transit, you would need to credit it with 500. So that reduces it by 500. And then you've also got the further credit to receivables. Here's that there of 1,000. Okay. Just don't forget you've got the bank. So that debit to the bank will need to be added to your bank balance. So that's the start. That's the first bit in terms of our adjustments.